Ever wondered why some stocks soar with groundbreaking innovations while others get stuck in a never ending price war? What if the key to picking winning investments lies in a Nobel Prize-winning theory that explains the hidden relationship between competition and innovation? Today, we're unlocking the inverted U curve, a game changing model that's reshaping how smart investors evaluate listed companies. Stick around because by the end of this episode, you'll know exactly which businesses to bet on and which to avoid using this revolutionary framework. This year's Nobel Prize in Economics didn't go to some abstract academic concept. It landed on a theory that's directly applicable to your investment portfolio. Winners Philippe Aghion and Peter Howitt expanded on Schumpeter's famous creative destruction to answer a question that's puzzled economists for decades. Is monopoly better for innovation, or does competition drive progress? Their answer? Neither extreme works. Instead, they uncovered the inverted U-shaped curve of competition and innovation, a simple yet powerful model that reveals when competition fuels breakthroughs and when it crushes them. The great debate, monopoly versus competition. Let's rewind to the roots of this debate. Schumpeter argued that monopolies rule at innovation because they can hoard profits from their breakthroughs, giving them more cash to reinvest. On the flip side, Kenneth Joseph Arrow insisted competition wins, since innovators can grab bigger market shares and gain a competitive edge. But Aghion and Howitt proved both were only half right. Their mathematical model showed the relationship isn't linear. It's an inverted U. Picture it. The vertical axis is innovation strength. The horizontal axis is competition intensity. At one end, absolute monopoly, innovation stagnates. At the other, perfect competition, profits vanish, and so does the cash for R&D. The sweet spot right in the middle. Plain language explanation, the milk tea shop analogy. Let's make this concrete with a relatable example. Imagine you own a milk tea shop. If you're the only game in town, Monopoly, you can charge 10 yen a cup and get complacent. No need to create new flavors when customers have no other options. Now, if there are 10 shops on the same street, perfect competition. The guy next door slashes prices to 5 yuan, forcing you to follow. Suddenly, you're scraping by just to cover ingredients. Forget about R&D, but if there are 2 to 3 competitors, that's the magic zone. He launches cheese milk tea, you roll out taro boba. You both innovate like crazy to win customers, and the whole industry thrives. That's the inverted U curve in action. Moderate competition equals maximum innovation. Real world case one. Apple and Samsung's co-opetition win. Now let's apply this to the stock market. Meet Apple and Samsung, the poster children for the inverted U's peak. Together, they dominate 70% of the global high-end smartphone market, but they still face pressure from Huawei and Xiaomi. This just enough competition has fueled relentless innovation. Apple's A-series chips, Pro RAW cameras, and seamless iOS ecosystem keep its gross margins above 40%. Samsung fights back with AMOLED screens, foldable devices, and its own Exynos chips. Neither is stuck in a price war, nor are they lazy from monopoly power. They're in the golden zone, proving that co-opetition drives long-term growth. Real-world case 2, PV companies' involution trap. Now let's look at the dark side of too much competition. First, solar and sun power. 2 U.S. solar giants fell victim to the inverted U's right side. Thanks to policy subsidies and overcapacity, the industry devolved into a brutal price war. Between 2015 and 2020, their R&D spending plummeted from 15% to 5%. They abandoned innovation to focus on cheap generic products. Predictably, China's Longai and Jinko Solar swept in with lower costs, stealing market share and sending First Solar's stock crashing 60%. This is the profit erosion effect in action. When competition gets too fierce, long term innovation dies. Investor takeaways. So, what does this mean for your portfolio? Think of competition and innovation like cooking. Too hot, excessive competition. Burns the dish. Too cold, monopoly. Leaves it raw. Here's your playbook. Target the golden zone. Invest in companies in moderate competition environments with crisis aware management. Apple and Nvidia are prime examples. Avoid involution traps. Steer clear of industries mired in price wars, like some traditional energy sectors. Watch policy moves. Antitrust laws and subsidies can shift the competitive landscape. Stay ahead of regulatory changes. Remember, the most successful investors don't just pick stocks, they understand the forces driving innovation. And now you have a Nobel Prize-winning tool to do just that.